All right, welcome back. Today, we're going to tackle the mystery box of the Income Tax Act. It's called Income from Other Sources. Now, this is the fifth and final head of income, and you can think of it as the ultimate catch-all category, where pretty much everything else lands. If you're prepping for the NISM exams or you work in finance, you absolutely have to master this. So, let's dive right in.
So, here's our game plan for today. First, we'll get a handle on what other sources actually is. Then, we'll dig into the two big ones, dividends and interest on securities. After that, we'll cover the really important and sometimes tricky rules about gifted securities. And finally, we'll do a quick-fire summary to make sure it all sticks.
Okay, so let's start with the basics. What exactly is this other sources category? Well, think of it like the tax code's big safety net. It's designed specifically to catch any type of income that doesn't quite fit into the other boxes.
Right. That's the perfect question. If the money you made isn't your salary, and it's not rent from a property, and it's not a business profit or a capital gain from selling something, where does it go? It has to be taxed somewhere, right? And that somewhere is right here. This is the catch-all for literally everything else.
You know, this is what we call the residuary head of income, and as you can probably tell from this list, the variety is just staggering. I mean, we're talking about everything from family pensions and lottery winnings to the interest you earn in your savings account. It's a huge, incredibly diverse category that's there to make sure no taxable income falls through the cracks.
Okay, now let's zoom in on a really big piece of this category, and it's one that has seen a massive change recently: dividend income. The way we tax dividends today is fundamentally different than it was just a few years ago.
So, at its core, a dividend is pretty simple, right? A company makes a profit and it shares some of that profit with its shareholders. But, and this is a big but, the tax definition is way broader. It also covers something called deemed dividends. These are things that might not be a direct cash payment, but are still seen as a distribution of profit, like a company giving a super low interest loan to one of its directors. So the key thing to remember is that it's more than just a simple check in the mail. Now this slide, this is a game changer. It shows you the huge shift. In the old days, companies paid something called a dividend distribution tax, or DDT, before they paid you. What that meant for you, the shareholder, was that the dividend was tax-free in your hands. But now, DDT is gone. It's been abolished. The whole idea was to make the system fairer. So instead of a flat tax on the company, the tax burden now falls on the person who actually gets the money, and it's taxed at your personal income tax slab rate. This is a critical change you have to know.
And with this big change comes a new piece of compliance. Companies now have to deduct tax at source, or TDS, before they pay you that dividend. Now, don't think of TDS as a new tax. It's more like an advance tax that's being paid for you. The money you receive will already have the TDS taken out, and you can then claim credit for that deduction when you go to file your income tax return. All right, let's switch gears from dividends to another key income source in this bucket: the interest you earn on various securities. The calculation here is pretty straightforward, but it's really important to get it right.
So, first off, what even counts as a security? Well, the official definition is actually pretty wide. It covers all the usual suspects, like government securities, corporate bonds, and debentures. But it also includes things like security receipts and units of a pooled investment vehicle, which you probably know better as a mutual fund or an alternative investment fund.
When it comes to calculating the taxable income from these securities, there's a very clear, logical process to follow. This slide gives you the basic formula, kind of like a bird's-eye view of the whole calculation. Now let's break it down step by step.
It's really just a simple three-step journey. First, you add up all the interest you received. That's your gross interest. Step 2, and this is super important, is you get to subtract any expenses you had purely to earn that income. This could be something like a collection charge your bank took, or maybe even interest you paid on a loan you took out specifically to buy those securities. Whatever's left after that is your net taxable income. Simple.
Okay, so we've talked about income you earn. Now let's pivot to assets you're given. Let's say someone gifts you some shares or securities. Is that a totally tax-free windfall? Well, the answer is, it depends. I want you to remember this number, 50,000 rupees, because if the total fair market value of all the securities you get as gifts in a single financial year goes over this 50,000 rupee threshold, the entire amount becomes taxable. And I mean the entire amount. It's a very strict all-or-nothing rule. For example, if you get shares worth 51,000 rupees, it's not just the extra 1,000 that gets taxed.
Nope, the full $51,000 is taxed. So even going over by just a little bit can have a pretty big tax impact.
So that naturally leads to the next question, doesn't it? Are there any exceptions to this rule? Is there any way around it? And the answer is yes. Thankfully, the law provides for several very important exemptions.
The first type of exemption is all about major life events. Any gift of securities you get on the occasion of your marriage is completely exempt. Doesn't matter what the value is. The same thing goes for anything you get through a will or as part of an inheritance. These are really significant and pretty common exceptions.
Then we have exemptions based on who is giving you the gift. And this is the big one. Gifts from relatives are completely exempt from that 50,000 rupee rule, as are gifts from certain institutions. But that word relative, that's the absolute key here, because the tax definition is incredibly specific.
And this is where the taxman's definition of family might be a little different from yours. As these lists show, the Income Tax Act spells out exactly who counts as a relative. It includes your spouse, parents, grandparents, children, and siblings. But here's what's critical. It does not include aunts, uncles, cousins, or friends. So a gift of shares worth 1 lakh rupees from your brother is totally tax-free. But that exact same gift from your best friend, that means the entire 1 lakh rupees is taxable income for you.
Okay, wow, we have covered a lot of ground. Let's pull everything together into one final summary of the absolute must-know points, especially if you're studying for an exam.
Let's lock this in. First, dividend distribution tax is a thing of the past. Dividends are now taxed in your hands at your personal slab rate. Second, the magic number for gifts is 50,000 rupees a year. Go over it, and the whole amount gets taxed. Third, remember gifts are exempt if they come from a specifically defined relative or if you receive them for your marriage. And fourth, when calculating interest income, always start with the gross amount and then subtract your eligible expenses to get to the taxable income.
Look, at the end of the day, these rules aren't just theory for an exam. They have very real-world consequences. Knowing how dividends are taxed is going to change your post-tax return expectations. And understanding the gift tax rules is absolutely vital for family wealth transfer and estate planning. So the real question I'll leave you with is, how is this knowledge going to shape your next investment decision?